Imagine waking up one morning, the sun streaming through your window, perhaps the birds chirping outside, and yet the world as you knew it has utterly collapsed. Not due to some natural disaster or war, but because the very foundation of your financial security, your life savings, your home, your business, has simply evaporated overnight. This isn't a scene from a dystopian novel. It's a terrifying reality that countless people have faced throughout history, a sudden, brutal awakening to absolute destitution. It's a story told in whispers and etched in the collective memory of nations, a stark reminder of the fragile line between prosperity and ruin. When we speak of people losing everything overnight, we're not talking about a simple market downturn or a few bad investments. We're delving into moments of systemic economic collapse, where wealth, whether held in currency, stocks, real estate, or even commodities, loses its value with breathtaking speed. These are the flashpoints in history where widespread panic transforms perceived riches into worthless paper or digital dust, leaving individuals and families utterly bewildered and bereft. From the dizzying heights of speculative bubbles bursting to the agonizing freefall of hyperinflation, the mechanisms might differ, but the crushing human outcome is tragically similar. It's about the sudden loss of purchasing power, savings, and the very means to sustain one's life, all within the span of a few harrowing hours or days. The journey to such catastrophic loss often follows a predictable, albeit tragic, trajectory like a financial play with several acts. It usually begins with a period of euphoria and speculation, where a particular asset, be it land, stocks, cryptocurrencies, or even something as seemingly mundane as tulip bulbs, captures the collective imagination. Easy money policies, readily available credit, or a novel technology fuels this initial excitement. People see others getting rich quickly, and a powerful fear of missing out takes hold, driving even cautious individuals to invest. Prices disconnect from any underlying intrinsic value, propelled instead by sheer optimism and the belief that the good times will never end. Everyone feels like a genius, and skepticism is dismissed as ignorance. Next comes the phase of growing overextension and early warning signs. As asset prices continue their improbable climb, debt levels balloon. People borrow heavily to participate, using their existing assets as collateral, amplifying their exposure. Meanwhile, a few astute observers or institutions might start to notice cracks, perhaps a slowdown in underlying economic activity, increasing interest rates, or unsustainable leverage ratios. They begin to quietly exit, but their concerns are largely drowned out by the chorus of bullish predictions and the momentum of the crowd. The market becomes increasingly fragile, like a house of cards waiting for the slightest breeze. Then arrives the catalyst, the moment the bubble bursts. This can be a specific event, a bank failure, a political crisis, a central bank tightening monetary policy, or simply a gradual erosion of confidence. Sometimes, it's just the realization that the prices are truly absurd, and there are no new buyers left. This single event, or often a series of small events, pricks the bubble. The illusion shatters. What follows is the brutal panic and freefall. The initial trickle of sellers turns into a torrent. Everyone tries to liquidate their assets at once, but there are far too few buyers. Prices plummet vertically, sometimes by 50% or more in a single day. Margin calls, where brokers demand more capital to cover leveraged positions, force even more selling, creating a vicious downward spiral. Businesses collapse as their assets become worthless, banks become insolvent, and the entire financial system seizes up. This is the truly overnight moment, where fortunes disappear faster than the market can even process. The sheer speed of wealth destruction is unimaginable until experienced. Finally, we endure the aftermath and the long, painful reckoning. The dust settles on a landscape of widespread bankruptcies, unemployment, and profound psychological trauma. Governments and central banks often step in with emergency measures, but the damage is done. It can take years, even decades, for economies to recover and for trust in the financial system to be rebuilt. For those who lost everything, the road back is often arduous, if not impossible. So why does this happen? The scientific explanation lies at the intersection of behavioral economics and fundamental economic principles. On the behavioral side, herd mentality is a powerful driver. Humans are social creatures, and in times of uncertainty, we often look to the actions of others. If everyone seems to be getting rich, it feels safer to join in, even if our rational mind has doubts. Cognitive biases also play a huge role. Confirmation bias leads us to seek out information that supports our bullish outlook, while anchoring makes us cling to previous high prices as a benchmark, even as assets crash. Fear and greed are primal emotions that override rational decision-making during both the build-up and the collapse. Economically, these events often stem from asset bubbles fueled by excessive liquidity and cheap credit. When money is easy to borrow, it flows into speculative investments, driving up prices artificially. Governments and central banks sometimes make crucial monetary policy mistakes, either by keeping interest rates too low for too long, inflating the money supply excessively, as seen in hyperinflation, or by tightening too aggressively, popping a fragile bubble. A lack of adequate regulation can also allow dangerous levels of leverage and risk-taking to proliferate unchecked, making the system vulnerable. Moreover, the interconnectedness of modern financial markets means that a crisis in one sector or country can quickly cascade globally, amplifying the shock. Given this historical pattern, what practical tips can we glean, and what common mistakes should we strive to avoid? First, and perhaps most crucially, understand intrinsic value. Don't just chase prices. If you can't explain why an asset is worth what you're paying for it, beyond just its going up, then you're speculating, not investing. Second, diversify your assets. Never put all your eggs in one basket, no matter how promising it seems. Spreading your investments across different asset classes, industries, and geographies can cushion the blow if one area collapses. Third, avoid excessive leverage. Borrowing heavily to invest magnifies your gains, but it also catastrophically amplifies your losses when markets turn. Fourth, maintain an emergency fund. Having several months of living expenses readily accessible can provide a crucial buffer during unexpected economic downturns, preventing forced selling of other assets. Finally, stay informed, but be critical. Don't fall for get-rich-quick schemes or believe the narrative that this time it's different. History shows us it rarely is. The biggest common mistake is, ironically, the one that makes everyone feel smart right before disaster strikes, chasing trends and ignoring red flags. Buying into an asset simply because everyone else is, or because its price has been soaring, is a recipe for disaster. Another significant error is emotional decision-making. Panic selling at the bottom or buying into euphoria at the top are driven by fear and greed, not by sound judgment. Lastly, over-reliance on debt and a complete lack of a diversified strategy are almost guaranteed ways to experience the crushing reality of losing everything overnight when the inevitable correction arrives. In the grand tapestry of financial history, the threads of boom and bust are interwoven with chilling regularity. While the names of the assets change, from Dutch tulips to Florida real estate, from dot-com stocks to modern cryptocurrencies. The underlying human psychology and economic principles remain eerily consistent. The story of people losing everything overnight serves not as a scare tactic, but as a profound educational lesson. It teaches us about the dangers of unchecked speculation, the fragility of confidence, and the enduring power of human emotions in shaping our financial destinies. By understanding these patterns, by embracing prudence, diversification, and a healthy skepticism towards promises of easy wealth, we can better navigate the unpredictable currents of the market and build a more resilient financial future, hopefully sparing ourselves the heartbreak of waking up to ruin.